Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich, and we're going to continue the conversation on Rachel's favorite topic, taxes.
Of course.
So kind of today we want to talk a little bit about the role of having financial advisors and helping women maximize their tax benefits. And so over time, we know that women have potential, well, we live longer, and potentially there might be some career changes, or there's some women that perhaps put their careers on hold to help with the family, and then they go back to their careers. There's some that just work through it and find ways to make it work. And so there's a lot of different things you can consider or think about along the way. And so we really want to kind of focus on looking at tax strategies for different life stages. And so kind of start with that point. And so with that, there comes maternity leave. Also, there's caregiving of family members potentially, career changes. There's so many different things that happen in our lives. And so there's obviously some ways we could take advantage of that from a tax perspective.
Yeah, there are a lot of tax planning opportunities that are available for the different seasons of life that you might be going through, because you may start out and have, a very high income, or, and then all of a sudden you decide, I'm going to stay home and take maternity leave for a year, maybe 5 years, and your income changes. And so it's really good to know what is available for you, what credits are out there. So I'll just name a couple. We clearly can't go into all of them. I could talk to you all day about them. But so if you are in in a season where let's just call them the low income years, there is something called the Earned Income Credit that is fantastic. It actually is a non-refundable and refundable credit, meaning if you don't even have tax, they pay you.
Oh, nice. Okay.
So if your income is somewhere between $18,000 and $66,000, depending on your filing status, how many kids you have, and so on, you may be eligible for that credit. The other credit that we advisors like to call the surprise credit, because we always forget about it, it's the saver's credit.
Oh,
and it doesn't really apply to many people. When it pops up, we're like, what's that number right there? And then it's like, oh yeah, that's the saver's credit. So if you contribute to a qualified plan, let's say a 401k, a 403b, so through your employer, or if you have a traditional IRA or a Roth IRA, and your income's, let's just say, between about $38,000 and $76,000, you may be eligible for this credit as well.
Okay.
And so those are two great credits that are available if your income's lower. And then there's another one that is, depending on your healthcare situation, if let's just say you're using the exchange for your healthcare premiums, if your income is lower, you could be eligible for a subsidy. And if you don't take the subsidy when you sign up for your insurance, when you file your tax return, you actually can still get that credit. So definitely something to discuss with with whoever helps you with insurance and with your financial advisors.
And then I guess another point is, if you are working still and it's not the lower income, one of the things you should consider is maximizing your retirement plan contributions. So you can put money into 401ks, solo 401ks, IRAs, Roth IRAs if you are eligible. But then also there's a spousal IRA. So if you're not working and your spouse is working, then there's a spousal IRA.
Exactly. I have a lot of women who ask me about that. My husband's saving for retirement, but what about me?
Yeah.
And so there is the opportunity because individual retirement arrangement, or IRA, it's a great way. You can do either tax deferred, which is the traditional, or you can do Roth. So depending on where your income is, that's where you make that determination.
And then another way to maximize is looking out if you're eligible for a health savings account. So a health savings account is available for not everybody, but for those that have access to this, you can put money away, and then it grows tax deferred and comes out tax free if you use it for health care.
It's great. You do have to make sure, though, that you have the correct plan, like you said.
So those are kind of some things to consider. Another area is tax-efficient investment planning. So if you are investing, you want to look at how are you positioning your investments? Is the money in tax-deferred or taxable accounts? And if it's in taxable accounts, then between now and the end of the year, usually by the end of the year, is there any tax loss harvesting, which means are you able to offset some of your gains with some losses or and with your investments? So there's some things to consider, throughout
And
the
this
year.
is really something important because there are planning opportunities available if you are selling investments and you have gains. It's better for you to contact us while you're doing it and not during tax season, but during the year, so we can help you plan. Because there are definitely ways to help you save money.
And then kind of looking at navigating your tax filing status. So that's probably something you see a lot.
That is a question I get all the time. What filing status should I be? And so basically there are 5 options. And so if you're single, you're single.
Yeah.
But you may be single and you may have a qualifying relative that lives with you, and or maybe you have a dependent child and you're not married and you have a child, then you can go head of household. Okay. If you're married, you have 2 options. You can be either married joint or married filing separately. And that typically the married filing separately status is not the best status, but sometimes it will surprise you. And you also have to know if you're in a community property state that it's not the best option for you. And then finally, there's a qualifying widower status that if you've lost a spouse and you have a dependent relative or child, you can use that filing status as well.
So as you're talking about, I know that's kind of how you file your taxes, but it's interesting. I feel this last year we've had a lot of conversations about how they should do their W-4 and they're making sure.
So many.
Yeah, that comes up a lot.
And I'll tell you, especially when we're filing people's taxes, that if people owe money, they want to know, well, how can I fix my W-4 so I don't end up owing? So it really is a good time of year. I would say, look at your pay stub every couple of months so that and if you're not a wage earner and maybe you're self-employed or maybe you're retired, you really want to be looking at, okay, where are my income sources and how do I fill out, if I have, let's say, an IRA that I'm taking a distribution from, or if I have a 401k where I'm taking money out, or typically Social Security doesn't have withholding. So oftentimes people will come in and they'll be surprised if they've got other income and Social Security why they owe, and it's, well, you need to plan for that other income, or maybe you have a lot of investment income, so you want to make sure you're planning ahead to cover those taxes. So do you think
there's a misconception then, perhaps, like if I'm doing a married filing joint, but then my W-4 I'm putting married, but maybe you should be putting single, just single. So it's a little tricky.
It's very tricky because the payroll tables are antiquated. So if you fill out that W-4 and you put married, they're assuming that it's 1950 and only one spouse is working. And so if you and your spouse make, let's just say, over $100,000, maybe even over $50,000, the withholding that's going to be, if you check married on your W-4, the withholding is going to be off. They're not going to take enough and you may end up owing. And that is a major stressor for people. And there are ways to navigate that form so that you don't end up owing at the end of the year.
Yeah. So that's one of the reasons why you should contact us. Obviously, we're here to help and guide and work through that.
Love doing tax planning. I want to make sure that people are paying enough, but not more than they should. And, it's better to keep your money working for you than giving you free loans to the government.
Exactly. So if you have any questions, you can reach us at 760-692-5700. So let's go ahead and continue. So we also have those that are planning for wealth transfer and estate planning for later. So we obviously know women typically outlive men, but that's just historically what we've seen. And so if the wife ends up with the money, making sure how is everything divvied up with beneficiaries, and I'm sure there's a lot of conversations prior, but making sure if there's trust or wills that are up to date are important. If there's any charitable donations, I know we've talked in the past about doing qualified charitable distributions if you have a required minimum distribution. And then also recently I had a conversation with a client who most of her money are in Roth and IRAs. She does have a little bit in taxable investments, but very little. So most of her estate are in the IRAs and Roth. And so we were talking, and so you can indicate on your Roth and IRAs who you want to designate as beneficiaries. And so with non-spouse beneficiaries, you have to now, with the Secure Act of 2.0, you have to take money out within 10 years, potentially based on the guidelines and where you land. And so we were talking about obviously your beneficiaries, are they higher, do they have high income, or how is this going to impact them later? And come to find out, she does want to leave money to her grandkids and as well. So she's going to rethink how she wants to designate some of these beneficiaries, because down the line, if you have Roth money, a lot of money in Roth, that's going to come out potentially tax-free. So there's, some different planning and techniques you can look at, and it isn't one size fits all. It's really kind of case by case based on your own financial situation.
And tax laws change.
Yeah.
And so, as you were saying, make sure you're reviewing your trusts and your wills, because at the end of 2025, well, who knows what's going to happen with the tax law, but the Tax Cuts and Jobs Act is set to expire at the end of the year, and so unless some changes are made, a lot more people will potentially be exposed to estate taxes. So maybe a good time to talk with an estate attorney and come up with a plan.
Yeah. And then another area that we look at is empowerment through financial literacy. So we are, even ourselves, we are big advocates for helping women learn about money and investing. We're committed to doing this, the Savvy series and providing content. We're also committed to doing live events and webinars. And so we definitely feel that being educated is a key component to your life and planning and making sure that you're making the right financial decisions for yourself. So if you'd like a complimentary consultation, you can reach us at 760-692-5700. Once again, that's 760-692-5700. And as we're kind of having this discussion on taxes, which is really on top of mind right now, I thought we'd talk a little bit about kind of tax-efficient investing for women and some things to think about. And so women, like we talked about, we live longer, so which means we need to have money last, and we need to have it there for retirement. And then, if you ended up taking a break or having kids or caregiving for family members later, how does that impact your overall financial situation? We actually had a client that we were working with, and she ended up she took a year off to go caregive for her husband, and then she ended up going back to work later. And so it's just one of those things. It's kind of case by case. Is that's important to you? How does that impact your overall plan? And those are the things that come up. You don't until it comes up. Until you live through that. It's not something you expect to happen, but those types of things do happen. And so when you look at kind of tax efficient investing, one of the areas we look at first is where are you putting your money and how are you investing? And so there are retirement accounts, like we mentioned earlier. There's 401ks, SEP IRAs, solo 401ks. There's traditional IRAs. There's Roth IRAs. In the 401k plans, there's usually a little bit of an increase each year as well. So that's something to make sure if you are maxing out your contributions that you're up to date and making those changes. And that kind of ties into also looking at your pay stubs and making sure what's the impact of these increases that you're making.
And I think it's really important to consider, the season. We talked about the season of life that you're in, because it may not make sense for you to do the tax deferred. Like a 401k or a traditional IRA where you're taking the money and taking the tax break right now. You may only be saving pennies on the dollar, and so it may make sense for you to put the money in a Roth instead. And I'm finishing up with a client right now with her return, and she thought she should be, I need to maximize my IRA. Well, come to look at it, she was only going to save about $50 by doing an $8,000 contribution.
Wow.
And so by putting it in the Roth, later that money will, it's going to grow now tax-free. Well, tax-deferred technically, and then it'll come out later tax-free. So I just think it's really important to be looking at, where is my income, what's my tax bracket, and does it make more sense to use this investment vehicle versus another?
What I've noticed also recently over the last 12 months is a few clients, prospective clients we've met with, that they ended up putting money in an IRA with after-tax money, but they already are maxing out their 401ks. And I don't think sometimes they realize the impact of what that means. And so it's just kind of interesting trying to look at some of
that's
the
a really
scenarios.
interesting one. I get that all the time with clients where they come in and they're like, oh, yeah, I did it. I put the money in my IRA.
Or they think they can get the deduction, too. And it's like you can't earn the IRA.
Or they think they can put money into a Roth, but maybe their income's too high. So there are limitations. And with a traditional IRA, if your income, if you, let's just say you have a 401k at work or a 403b, some sort of a qualified plan through your employer, and your income's a certain level, or maybe your spouse even, and you don't have one, but your spouse does, that will disqualify you once your income hits a certain level. And so that you don't get the deduction. So and then it creates all sorts of interesting scenarios where you have to actually track how much you put in because you didn't take the tax break for it. So definitely want to work with an advisor to make sure you're picking the right plan, the one that makes the most sense for you, not only now but also later.
So it is important to understand also where your investments are allocated and how they're positioned. So there are different types of accounts. We talked about taxable and IRAs, and then looking at, as we work with our clients and they're phasing into retirement, a lot of times they're looking for income and where are we going to get the money from. So that's where the planning and investment allocation comes into play, of really digging into how are my investments positioned, where am I pulling the money from, what are the tax consequences. So it is not only are we diversified with our asset allocation, but also where is the money and how are we taking distributions if you are in that season of life in retirement. And then another area with investing is, we talked about earlier, is the tax loss harvesting. So once again, looking at your positions, if you have taxable money, and are there ways to offset some of your gains in a year. And it's, we still want you to make money. I mean, that's the reality, is we want your money to grow. And but at the end of the day, there's also some ways to limit some of the taxes.
And the way that works is basically if you've got capital gains, or let's just say capital gain distributions from mutual funds, and then you have some other accounts that maybe aren't performing as well, you can sell those. And so the losses and the gains net at the end of the day. So it wipes out your gains.
And it's interesting because I get calls sometimes, I didn't, they understand, but it's hard sometimes when you realize I put after-tax money, I made money, and now I have to pay taxes on this.
Right.
It's like, what happened? But, there was no free lunch.
Exactly.
Okay, and then the other thing is, we mentioned, is a spousal IRA. So once again, if you're not working, you may be able to contribute to a spousal IRA based on your spouse's earned income. So those are some, making sure you look at that. And then staying invested long term. So we're big advocates of having a long-term plan. And it's not a short term. The markets fluctuate, which we're experiencing right now, and the markets move very, very quickly. We do have a long-term perspective in mind for our clients, and that's why we have a plan. We have our investments allocated, diversified, because obviously, every day, everybody always wants the upside. Nobody wants downside, but the reality is the markets are going to fluctuate over time. So it is important to have a long-term perspective if you can, and depending on where you're at with the phase of life you're in. And then we do think, continuing to educate yourself and learn. We provide a lot of education resources and events. And, once again, we suggest working with an advisor. We're here as resources. But, hopefully you took some key points away today. And if you'd like a complimentary call or session with us, once again, you can reach us at 760-692-5700. And thank you for joining us. And remember to get savvy about your finances and savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.